Welcome to Credit and Bankruptcy with Reed Allmand. Reclaim your power for financial independence. And now, your host, Reed Allmand.
Hello, everyone. Welcome to another episode of Credit and Bankruptcy. We're helping you reclaim your power for financial independence. And today we've got a special guest, Darrin Mish, who is a tax attorney out of Florida who helps people all across the nation with tax issues. So we're going to be getting with him today. And we're offering a two-part episode that we're going to be discussing taxes. First, we're going to tackle taxes in bankruptcy and how bankruptcy is handled with taxes, what's dischargeable, what needs to happen regarding filing returns. And then with our second episode, we're going to dive into some non-bankruptcy options to help you with your taxes. So I want to welcome Darrin Mish to the show. Hey, Darrin.
Hey, Reed. Thanks for having me.
Appreciate you taking time out today to help us go over this. So I wanted to start first with, how bankruptcy and taxes work. Being a tax professional, and I know you've done some bankruptcy in the past, what do you think is a common misconception that people have about taxes when they're filing bankruptcy?
Well, I think probably 9 out of 10 attorneys, let alone the general public, have a belief that taxes are not dischargeable in bankruptcy, and nothing could be farther from the truth. So I'm really excited to be with you today and explain this, because there's so much information or misinformation out there about the fact that taxes cannot be discharged in bankruptcy, that it's good to get that word out there.
Yeah, and the concepts of like how to determine what is dischargeable in bankruptcy and the ins and outs are actually very confusing, even for bankruptcy attorneys, much let alone the layperson out there, because there's a lot of moving parts. And so we're going to do our best during this episode to kind of break it up for you and lay it out so you can kind of understand the key components on a higher level of how taxes work in bankruptcy. So first, I want to discuss the types of bankruptcy that a consumer can file for. We got Chapter 7, which is the liquidation of bankruptcy. So that liquidates all your unsecured debt, including any dischargeable IRS tax debt. And then we have Chapter 13, which is similar to Chapter 7, but you have the option in a 13 to make payments. So certain IRS debt that's non-dischargeable can be paid for during the Chapter 13 plan, so that when you come out of the bankruptcy, you are truly debt-free and getting that fresh start you're looking for. So I'm going to go ahead and jump in right now and kind of tell you the different ways that taxes can be dischargeable. So there's a few key components. And the first one I want to talk about is number one, for the taxes to be dischargeable, the tax debt has to be more than 3 years old. So Darrin, how do you think the IRS determines how the 3 years is calculated?
Well, technically the rule is the tax debt has to have been at least 3 years old, or 3 years from the date of filing of 3 years from the due date of the return, including extension. So if a tax debt was due on April the 15th of 2010, for example, plus 3 years is April 16th, 2013. If the taxpayer had filed an extension for that year, it moves that date from April the 15th to October the 15th. So it'd be 3 years plus a day. So October the 16th of 2013. So the 3-year rule is actually a pretty easy rule to calculate. We don't even have to look at IRS transcripts or do much in the way of calculations, except for that exception that we have to make sure if there was an extension filed, we have to make sure that we take that into account.
Right. So it's kind of like this whole issue that we're talking about. It's deceptively easy, but there's a lot of ways to trip up. For example, this year, the tax deadline has been pushed to July 15th. So you can't necessarily say, we're talking about the last 3 years tax returns that are due. So currently 2019 tax returns are not due until July 15th. So we wouldn't be able to include any taxes for this year in 3 years until we waited until July 15th, if that makes any sense, what I'm saying.
Yeah, I hadn't thought about that until you just mentioned that, but absolutely, going forward, that's going to be yet another exception to the rule, right? So we're going to have to remember, 2019 was the coronavirus year, so it's actually July the 16th of 2023 for tax year 2019.
Yeah, the joys. And then that's not to mention too, if the 15th falls on like a Saturday or Sunday, it's actually the Monday after that when you start the calculation.
Yeah. And then there's an interesting exception there too, where I believe it's called Patriot Day is sometimes falls on either April 15th or October 15th up in Massachusetts. And so for Massachusetts taxpayers, you have to remember Patriots Day sometimes falls on the due day. So yeah, the calculation of deadlines can often be quite a struggle. And it's not something that really the layperson should endeavor to do themselves. It's just too complicated. In fact, we use software to do it.
Yeah, exactly. So we're going to move on now. So to recap, we're talking about number one, for it to be dischargeable automatically. So if you're going to file Chapter 7 and you file the return and the taxes are more than 3 years old, then potentially they're going to be discharged just like a credit card or medical bill, same in the 13. If the taxes are not 3 years old, and you file the bankruptcy and you have tax liability within 3 years of filing, that tax debt is called priority debt. And we're going to talk about that a little bit more as we get further in the broadcast. But in short, that is the type of debt that typically you would be paying for during the Chapter 13 proceeding, so that when you finished, that would be wiped out. All right, so the second element that we're going to look at to determine whether the tax debt is going to be dischargeable in the bankruptcy is if the tax returns have been filed, and have they been on file for the last 2 years. And so, Darrin, you want to talk about some of the complications and exceptions for this rule?
Yeah, so when I first started practicing law, and by the way, it took me 2 years to actually ingrain these rules in my head so that I feel like they're fairly straightforward now, but I mean, 2 years is a long time. But the rule is essentially, if the return was filed late, it has to have been filed for at least 2 years, except there's an exception in the Fifth Circuit, which is where Texas is. And there's some case law that says if the return was not filed timely, meaning by April 15th or October 15th with an extension, then the tax return can never, the return is not a return, therefore it can never be discharged in bankruptcy. But as far as I know, everywhere outside of the Fifth Circuit, the late filing of a tax return is not a problem. And I know you and I were talking about this before the show actually started, and you were indicating to me that even in the Fifth Circuit, at least in Texas, the IRS is interpreting that rule to be more liberal, meaning a late filed return can, in some circumstances, be discharged. So it does get fairly complicated pretty quickly.
Right. So in Dallas-Fort Worth, where we practice here, the IRS bankruptcy specialists usually don't apply that Fifth Circuit case, which is called McCoy, to the bankruptcy proceedings. They usually follow the general rule that's followed, throughout the United States. But it's still out there, and it's still something we have to factor in and make sure our clients are put on notice about. So I would say that if I'm giving anybody a tip out there who's listening to me who has tax liability or may in the future, the number one mistake that I think my clients make, and probably you would share this sentiment, Darrin, is not filing their tax returns. It's very common for people who are going to owe, or they're afraid they're going to owe, that they just kind of bury their hand in the sand and try to hide from the IRS and not file the tax return. And really, if you would just have filed it, even if you owed $100,000, if it was timely filed, potentially we could discharge it in the bankruptcy. Would you share that tip?
Yeah, I totally agree with you. Human fear is an interesting thing, and that's the reason that people don't file, is that they feel like if they actually prepare and file the return, that something bad is going to happen immediately, and they're just afraid. And I'm not blaming them. It's just a normal human emotion. But I do agree that if you can, you should file your returns as timely as you can. In my practice, I sometimes see people who haven't filed in 10, 20, 30, 40 years, but there's a number of timing limitations or timing mechanisms that don't start to even run until you file the returns outside of bankruptcy. And so that's a great tip, is to go ahead and file your returns, if at all humanly possible, so that you can get some of those beneficial timing mechanisms to start to run to your benefit.
Right. And also, a lot of times we will have clients who file the bankruptcy case, and then the IRS will file a proof of claim, and they will file estimated tax liability because the IRS will file a substitutive return. And when the IRS files that substitute return, it's extremely unfavorable for the individual, the consumer, or the debtor who's going to be filing for bankruptcy, because they don't really take into consideration any of your deductions, and it's often much higher than what you would if you had actually filed the return. Is that what you see as well?
Yeah, so let's talk about what a substitute for return is real quick. A substitute for return is filed by the IRS when the taxpayer doesn't file a paper, their own version of the return. And so what the IRS does is they take typically the 1099 information or the income information, and they just multiply it by the highest tax rate possible. They don't give any exemptions, any deductions, and it just typically calculates a massive tax liability. And it's never in the best interest of the virtually never in the best interest of the client to accept that substitute for return. And there's some case law with regard to bankruptcy that indicates that substitute for returns are never dischargeable. Back in the day, we would have clients with substitute for returns. We would file a subsequent original return, knock that tax liability back, to what was appropriate, and then we would wait the 2 years, and then we would file a bankruptcy. That does not seem to be as effective anymore, just under some precedent that's in cases that have been passed since that time.
Right. And so the final rule, which kind of makes common sense, if there's any kind of fraud or willful evasion, even if you would otherwise pass all the tests to determine dischargeability, those would be accepted from discharge by the IRS if there's any kind of fraud or willful evasion. Go ahead.
Yeah, that's correct. It's pretty rare. There have been some cases where the IRS has tried to sort of bootstrap these rules into like the more common scenarios where you just have a taxpayer who was a business owner, hadn't filed for 10 years, and then eventually filed and was trying to ultimately seek a discharge. And they said, well, that was willful evasion. And the courts have pretty much indicated that that's not the type of evasion that they're talking about. They're really talking about very egregious evasion, the hiding of significant assets and that kind of thing.
Okay, great. So let's recap real quick. So for those of you that are watching, I'm going to run through it real quick. Number one, the tax liability has to be more than 3 years old. Number two, you have to have timely filed the tax return. If it wasn't timely filed, you need to have it at least be on file 2 years before the bankruptcy case is filed. Also, you have to have no willful evasion. And I actually just realized we left out another element, which is that the tax liability cannot have been assessed within 240 days before filing the case.
Yeah, and so that's interesting because typically if the return was filed within 3 years of the due date of the return and or filed for at least 2 years, if it was filed late, typically you wouldn't have a problem with having 240 days pass since the assessment of the tax. But here's where it can come into play. I have a case like this right now where taxpayers being audited for 2016, 2017, 2018, right? And so there's going to be a subsequent assessment of tax. There's going to be an addition of tax to his tax liability. And so we have to make sure that those assessments have been at least 240 days old before we file the Chapter 7 in his case. Does that make sense? Right. So if he files a return with a balance due, that's assessment number one, and then there's a subsequent audit, then that's assessment number two, and we want to make sure we have at least 240 days from assessment number two if we're going to try and wipe it all out of the bankruptcy.
For those listening who don't know, can you tell me what is an assessment exactly?
It's one of those things that's a little bit hard to define, but an assessment is an action that the IRS takes to assert that a liability is owed. So if you file a tax return with a liability owed, when that return is processed, there's an assessment of that amount. It's like, okay, Reed, you owe this amount. And that's how it happens in an audit situation too. If you go through an audit and you ultimately agree to the audit findings, then there will be an assessment. If you go to tax court and you fight it and you ultimately lose, there will be an assessment. So it's a determination of tax liability owed.
Right. So if you get through all of these hoops and it's more than 3 years old, you filed it timely, or at least it's been on file for 2 years, there's no assessments within 240 days before filing, and no fraud or willful evasion, then that tax debt will be subject to discharge in a Chapter 7 or in a Chapter 13 as an unsecured debt. And it'd be nice if we could just stop right there, but there's some additional things to consider what if it doesn't meet all those requirements? And so if you have a tax liability that is more than 3 years old, but let's say you never filed the tax return, then that would still be an unsecured debt, but it would not be dischargeable in a Chapter 7 or Chapter 13 bankruptcy. However, some of that liability associated with that tax year could still be discharged. Isn't that right, Darrin?
Yes, some of that liability there can be some exceptions for penalties and interest that are assessed that aren't necessarily subject to discharge. And so that can be an advantage to a taxpayer, particularly in a 13.
Well, that's interesting because earlier this week I was talking to a lady and she had $20,000 of tax liability listed on her IRS proof of claim, but $5,000 of that was related to penalties for a tax year that was more than 3 years old, but she hadn't filed the return timely. So we were still able to discharge $5,000 of that $20,000 liability through the bankruptcy proceedings.
That's great. That's really exciting when that happens. And that's good work. That's good bankruptcy work right there.
Yeah. So, she still got a pretty good benefit. We're talking about a good portion of that was wiped out. And then at least when she's coming out of bankruptcy, she's got a smaller balance to deal with some of their non-bankruptcy options with the IRS, which we're going to touch on again in episode 2 of this 2-part podcast series. All right, so we've gone over the elements to determine dischargeability. We've touched on the fact that if the taxes are more than 3 years old and they meet these other tests we talked about, they're considered unsecured and discharged in the bankruptcy, or unsecured and not dischargeable. And we've also mentioned that the tax liability that you incur within 3 years of filing is considered priority taxes. And if you file a Chapter 7, those would survive the Chapter 7 proceeding and be non-dischargeable. Or if you file a 13, you have the option to pay that priority debt through the Chapter 13. So Darrin, what advantage do you think a consumer would have electing to pay the priority debt through the Chapter 13?
Well, the interest and penalties are greatly reduced. And we do find some cases where the amount owed to the IRS is significant enough that a revenue officer has been assigned to the case, and the revenue officer is not inclined to give the taxpayer an installment agreement amount, a monthly payment amount, that is manageable. And so a lot of times, as more of a tax practitioner, I think of a Chapter 13 as more of like a forced installment agreement where the taxpayer is actually forcing the government into the installment agreement, typically right over a 60-month plan. And then it's particularly appropriate when there's other debts that are pressing on the taxpayer and whatnot. And so the Chapter 13 is real nice. It wraps it all in a nice package for them. And they know if they meet their end of the obligation that this is all going to end up well for them.
That's a good point, because oftentimes financial problems are not isolated to just one category of debt. Typically, if somebody has IRS debt, they may also have mortgage arrears, issues with their car, unsecured debts, maybe somebody's suing them. And so, like you pointed out, a Chapter 13 is a good way to kind of wrap all that together, because we can address with all categories of debt and be able to put you on a payment plan to get those debts discharged. And I think it's important for us to recognize that not all tax debt is the same. And so what we've been referring to so far in this broadcast is we've been talking about income tax, but there's also payroll taxes. And Darrin, can you touch on like how payroll taxes are handled in the bankruptcy and how they differ from income taxes?
So generally speaking, payroll taxes are what's called a priority tax, and they're never dischargeable in a bankruptcy. It doesn't mean they can't be handled in a bankruptcy. It just means you're never going to obtain a discharge. And this also means that what's called the trust fund recovery penalty, or the civil penalty that the IRS will ultimately assess against the individual that's personally responsible for having not paid those payroll taxes, that trust fund recovery penalty will never be dischargeable in a bankruptcy either. Now, typically, my understanding of the way those payroll taxes are handled in a bankruptcy is that if it's in a Chapter 7, they're essentially just ignored and they survive the discharge and they're there waiting for you on the backside. In a Chapter 13 or a Chapter 11, which we haven't referenced yet, which is really just, in a sense, a business Chapter 13, they typically you have to make allowances to full pay those payroll taxes within the life of the plan.
Right. Exactly. So sometimes, it's a good 1-2 punch. We may do Chapter 7 to wipe out some income taxes, some unsecured debt, and then deal with the taxes that survive the Chapter 7 with the IRS, because at least you're starting off with the IRS with a much lower liability, and you're going to be dealing with those payroll taxes, which really cannot really easily be handled in a bankruptcy unless you do a 13 and provide to pay for them.
And we really call that, like, our slang for that is a Chapter 20, right? Because we do a 7 first and then we do a 13, and so it's a 20. And it's kind of rare, but it's appropriate in certain cases, right? Where it's like maybe the taxpayer owes $300,000 in income tax and they owe $100,000 in payroll tax. Well, you do the 7 first, get rid of the $300,000, and then you do a 13 for the last 100, and you'd pay that out over the life of the plan. And that 60-month plan may very well be more advantageous to the taxpayer than the taxpayer trying to work that out with the IRS on their own administratively.
And so I hope what y'all are taking away from this is that there is help out there for you if you have tax liability, and there's a lot of deadlines, there's a lot of eligibility rules, there's tricks of the trade, in Chapter 7 and Chapter 13 bankruptcy, as well as outside of bankruptcy with a good tax attorney. And so if you do have financial issues related to your tax liability, I'd encourage you right now to reach out to us at 214-265-0123. We'll be able to schedule you a free virtual consultation. We're actually able to file your case, your bankruptcy case, without you ever leaving your home right now. We're set up to visit with you virtually and also have ability with the court to electronically file your case. So I just want to put that in there right now. If you have tax liability, hope we've illustrated to you so far why you really need a professional to help you sort through it. And we're not done yet. We also have another category of debt. We've talked about priority. We've talked about unsecured. We've talked about unsecured non-dischargeable that survives the bankruptcy. But we have another one. It's called secured. And so the secured tax liability is going to be involved when the IRS has filed a tax lien. And so it kind of throws everything else on the head that we've talked about, because even if the tax debt is more than 3 years old, it's been on file for 2 years, you filed it timely, it hasn't been assessed, there's no willful fraud or evasion, but an IRS lien has been filed, even though the taxes would otherwise be dischargeable in the bankruptcy, the lien now is secured that tax liability against any real or personal property you have. So you may be thinking, okay, well, game over. But that's not the case, because in a Chapter 13 bankruptcy, you have to, we're able to take any equity that you have in real and personal property. So if you keep in mind now, if you don't have any real property, no houses, lands, or you have those and there's no equity in them, you owe about what they're worth, then you wouldn't have to pay anything back on that tax lien because there's no equity. Personal property, most people's personal property, if you're talking about, household goods and furnishings, we're talking about like garage sale value. So oftentimes we're still able to take a very large tax debt, let's say $100,000, and we've got $5,000 worth of equity in real and personal property. In a 13, we provide to pay the IRS $5,000, but the other $95,000 would be wiped out, and the IRS would then remove that tax lien. So, Darrin, I know you have some other thoughts about how the tax lien can be handled in Chapter 7, and also some thoughts, outside of bankruptcy as well.
Yeah, so it's kind of an interesting thing to think about, because when you're like, okay, so we passed all the timing rules, there's no willful, there's no fraud or willful evasion, so we ought to be able to get a discharge in a Chapter 7, right? Well, except if there's a federal tax lien filed, then that lien attaches to, like you said, all your property, real and personal, wherever it may be. So let's take the situation where there's minimal equity in the house. And this determination has to be made as to the equity in that real property as of the date of the filing of the petition. So especially in times like this, where we're having like these wild economic, swings, sometimes you file a bankruptcy and there's no equity in your house. And then sometimes maybe that equity goes up, nobody deals with the lien, and the lien survives and it's still there 5 years later, and now you have lots of equity in your house. So one rule to think about is that the lien does not attach to post-petition equity appreciation. So that's huge, and I know that people mess that up all the time. And the IRS might even try to, attach it to post-petition equity appreciation, but that's not appropriate. The other situation that comes to mind is, let's say there's a minimal amount of equity, $5,000 equity in the real property, and you're not making any provision to pay them in a Chapter 7, because that's not how a Chapter 7 works. So in theory, that lien survives the bankruptcy, and typically what will happen is the insolvency unit at the IRS will reach out to the taxpayer, usually through counsel, and say, hey, we got this lien that survived. Let's make a deal to get this lien released in some fashion. And so on a $5,000 debt, sometimes they may take $1,000, sometimes they might insist on the whole $5,000. But at any rate, it's going to be better for the taxpayer to get that lien removed, released, at the conclusion of a Chapter 7. And so it doesn't just hang around, because it's not necessarily impacting their credit anymore, but it is definitely impacting their ability to acquire new real property, or convey that real property.
Exactly. So to kind of illustrate one of your points, let's say somebody did a Chapter 7, they owed $100,000 in tax liability. On their bankruptcy schedules, they listed equity in their real and personal property of $5,000. The bankruptcy discharge happens, they wander into your office 10 years later, and now they have $200,000 equity in their house. They're not going to have to pay more than $5,000 to the IRS to get the tax lien removed, correct? Is that how we apply that?
Correct. As a practical matter, it's going to be a bit sticky to unravel, but that is what the law provides for.
Yeah. So that's another a great benefit of doing the bankruptcy and dealing with the tax debt after that. So a couple of things I want to touch on. Before they do that, Darrin, I mentioned earlier how they could get a hold of Allmand Law Firm. If somebody does have some tax liability that they're looking to deal with, how would they get a hold of you?
Well, we represent clients nationwide because taxes are a federal subject matter, and they can reach us toll free at 888-GET-MISH, that's GETMISH, or they can visit our website at getirshelp.com.
Okay, great. So GetMish or getirshelp.com. That's very, very catchy. I want to touch on a couple other things related to bankruptcy. Under the bankruptcy code, it provides that you're required to file your tax returns at least for 4 years before filing. So earlier, my tip or my suggestion for this episode was that you really don't need to delay in getting your tax returns filed, if at all possible. If you have the information, you can get it filed, but you're just concerned because you're afraid the IRS will now start coming after you, or they'll speed up their collection efforts. You need to go ahead and get those filed, because it really will determine if you're going to be able to potentially discharge that in the future. But if you file bankruptcy and you haven't filed your last 10 years tax returns, the bankruptcy code is going to require you to at least file the last 4 years before you can file the bankruptcy case, or in very short order after you file the bankruptcy case. Also, while you're in a Chapter 13 payment plan, you're required to continue to file your tax returns timely as the plan continues to go forward. So most plans are 3 to 5 years. So you're looking at the obligation to continue to file those tax returns timely, which I always suggest to my clients. It's great because we're dealing with any past issues. We're getting you on a new healthy habit of keeping track of your financials and getting your tax returns filed and going for there. Darrin, any other concerns you can think of, maybe related to taxes after someone files a bankruptcy case?
Well, just to reiterate what you just said, they have to file the last 4 years of tax returns. So if they've waited and and haven't filed timely, and now they have to file 4 years of tax returns, it's very likely that they're going to have liabilities, and it's going to prevent them from obtaining the discharge and further complicate the Chapter 13. So just to reinforce, and I think we're beating a dead horse a little bit here, but they should file those returns on time if they can. It just makes our job as advocates for them much easier and more effective. In terms of filing the returns subsequent to a bankruptcy, it's just so crucial that they figure out, they get the assistance from someone to help them figure out why they're continuing to have tax liabilities moving forward. I really harp on this a lot, and that is, if we can't change that behavior going forward, then we really haven't solved the problem. We have to solve that typically a behavioral problem that's incurring new tax liabilities year after year. And if we don't solve that underlying issue, then we're just going to be back in this mess at some time in the future. And so, even though sometimes clients don't want me to harp on that, I'm really strident about making sure that they understand what they need to do going forward, because we just, people think that lawyers are heartless. No, we actually want the best for you, and we want you to stay out of trouble. I'm actually not a huge fan of a repeat tax problem client business. That means I failed the first time.
And a couple points about that, you're looking at most of the time small business owners, when they start their business, and they're very well intentioned, but there's not really like an entrepreneurial class or how to stay out of trouble when you start your small business. Most people learn the hard way. And you have to really be disciplined and recognize what type of activities and how you're running things will, contribute to tax liability. Are you taking money out of the business for personal use that you should really be counting as income? Are you making your quarterly tax payments? You really need to think about those things and consider the IRS whenever you're taking any money out of the business, and set aside their portion, because it can creep up on you real fast. And that's probably the number one reason I think why small businesses fail.
The reason that Congress so long ago passed that statute with regard to forced withholdings from W-2 paychecks was because prior to that time, they didn't take the tax out of your paychecks. And so the vast majority of America had a tax bill on April 15th. And so they had to figure out a way to sort of force it on us so that they could, two things, they could collect the tax more efficiently, but they could raise the tax rates without people noticing too much and getting up in arms about it. And so there's forced withholding from a W-2. In a 1099 small business owner sort of situation, the business owner is not paying their taxes along the way unless they're going to make quarterly tax payments. But Reed, I don't think quarterly tax payments make that much sense. Let me give you a short example. Let's say the taxpayer, small business owner, is supposed to pay $3,000 a month quarterly, okay? They're going to intend to do that, but about day 85, they're going to look in their checking account. There's not going to be $3,000 just magically appear there, and it's going to be seemingly insurmountable. And so what I counsel clients to do is, let's break that up into smaller pieces. Let's think about it as $1,000 a month, and maybe pay your estimated tax payments once a month. And if that still seems like too much, okay, let's break it down to $250 a week. Can you do $250 a week? And 9 times out of 10, people say, yeah, I can do $250 a week, but I can't do $3,000 a quarter. Okay, fine. Let's make our estimated taxes payments once a week. And that way, even if we didn't hit that estimated tax number right on the head, at the end of the year, you're going to have a big pot of money having been paid in, and any liability that you do owe is going to be that much more manageable. Now, if you paid in too much, you get a refund. This is a beautiful thing for a small business owner. We're not used to having refunds, right? But that's really that is actually the recipe that I follow in my own business, is I pay them more frequently than less frequently.
I think that's great advice. I also follow that advice. Anytime any money is going to come out that would be a taxable event, I try to carve out the IRS's portion and put it into another account that I have an ACH arrangement with the IRS to then be able to transfer that directly over to them. So it kind of pay as you go. And you actually provided a great segue for what I want to talk about next, and that's refunds. And so tax refunds are handled differently, in bankruptcy, and there's some things that you should be aware of. Number one, there's any tax refund that you're entitled to before you file the bankruptcy case. And I know throughout this, we've kind of just been assuming that if you didn't file the tax return, then you owe the IRS. But a lot of times, and maybe the majority of the times, my clients who have not filed a tax return maybe were even entitled to a refund, or they don't. When they finish the tax return, they owe no IRS taxes or significantly less than what the IRS thought. Darrin, what happens to you if you file your tax returns late and you're entitled to a refund? Are you always able to get that refund back?
No, there's actually a really unfair statute called the refund statute of limitations, and it's essentially 3 years from the due date of the return. I had an attorney client, actually, who was a very high income wage earner that for whatever reason, she was a trial attorney, she got behind on filing her tax returns to the tune of about 6 years. So we went ahead and prepared all the returns, and she had a refund, significant refunds, $20,000 and more on each year for all of those 6 years. Now here's where the refund statute kicks in. She didn't get the refunds for those 3 years that were too old, and she didn't get any credit even towards any taxes she might have owed for those 3 years, but she did get the 3 years refund, the newer 3 years. And so she just learned a really valuable lesson. She needs to file her tax returns on time. She needs to be a little less busy when it comes to filing season and just get it done. But the sort of sad thing about that case was those returns were really pretty straightforward. She just let life get ahead of her, like happens to a lot of us, And it doesn't help that when we're late with an IRS filing, or we don't file an IRS filing that's required, that a lot of times the IRS is so understaffed and undermanned that years can go by with you hearing nothing. So there's no pressure, and so 1 year snowballs to 2, and then guilt and fear sets in. And like I said, I think my record is I met with a gentleman one time who hadn't filed returns in over 45 years and lived in fear that entire time.
Yeah, that's the intangible part that people don't realize is, you don't want to face it, but typically throughout this process, we'll help our clients get through that, get those taxes filed. And there's just this unbelievable relief that they have. They didn't even realize the kind of pressure and stress they were living on, waiting for the shoe to drop, that the next time they turn around, the IRS is going to be coming after them and taking their stuff. So the tax liability, let's say we talked about you're entitled to a refund before you file the bankruptcy case, but you haven't received it yet. The good news is most of our clients are able to exempt that tax refund. So even though they receive it after filing, it's going to be exempt, which means that they're able to keep it. And exemptions are something provided for under the federal law and under state law that allows you to keep your property, equity in your property after you file the case. But there's another wrinkle in this scenario is, what about the taxes that you file after the bankruptcy case is filed? So in a Chapter 7, any tax liability or tax return that you're going to have, of refund after the bankruptcy case is filed, that's going to be your property, because we're only interested in property interests you had before you filed the bankruptcy case. So let's say you filed a Chapter 7 right now. You've already received your 2019 tax refund. You were entitled to it. You got it early. You filed it early. And now in 2020, after your bankruptcy case is discharged, you get a refund. That's yours to keep. Okay. In a Chapter 13, like we talked about, it's a 3 to 5 year plan. And so the tax refunds that you get after filing may or may not be yours to keep. In the Northern District of Texas and Eastern District of Texas, the policy for tax refunds received after filing is that the first $2,000 of that tax refund is yours to keep, no questions asked. And whatever is in excess of $2,000, the Chapter 13 trustee wants you to pay in towards your bankruptcy plan. However, the IRS always retains the right to set off your tax liability. Isn't that right, Darrin?
Yes, they do. If you have an existing tax liability, then any refunds that you may otherwise be entitled to are going to be captured and offset by the IRS. I had another interesting thought as you were talking about that, and that is that taxpayers don't realize it, but they have virtually all control to prevent a refund going forward, right? Because if you're a small business owner, then you simply make an adjustment for your fourth quarter estimated tax payment, and you could essentially get it to zero or pretty close to zero. But a wage earner, and that's who most people are, they can actually go and make an adjustment to their W-4 and make sure that slightly less withholding is taken out so that they don't get these $8,000 refunds and things like that. Now, when you're going to monkey around with your W-4, you have to be very careful that you don't swing the pendulum the other way to where you're going to owe. And so I would suggest that you get some advice and counsel prior to making the adjustment on your W-4 with your employer. But ultimately, there should be no reason for taxpayers in a Chapter 13 to have very large tax refunds going forward. They should be adjusting their withholding and preventing that.
Exactly. So I know we're almost running out of time for this episode here, and I wanted to remind everybody that earlier in the show we shared our bankruptcy tip to get those tax returns filed if you have the information. Filing on time is always better than not filing on time. And there's some tax issues in the news that I wanted to touch on. Darrin, can you tell me what about this Family First issue that's in the news right now?
Back in March, the IRS passed the Family First program, and what that essentially did was it extended the tax filing deadline until July the 15th, and so that was great. But more importantly for my clients, what it did is it ceased virtually all collection action by the IRS as well. What that means is the IRS at this point in time, until at least July the 15th, and there's a high likelihood that this could be extended. We don't know for sure, but Treasury Secretary Mnuchin has been hinting that they're going to be extending this program and maybe even the filing deadline. But what that means is the IRS cannot levy or lien any taxpayers at this point until at least July the 15th. Now, the IRS has essentially taken a 4-month, shutdown at this point, and so they're going to be at least a year, if not more, behind in their collection efforts. So I think it's important to note that if you have a tax liability, you're kind of in like a timeout right now, but that timeout will end. And so I would encourage people to take advantage of the timeout, because that gives us as counsel more time to figure out what their best solution is to resolve their problems.
Okay. All right. Well, Darrin, I want to thank you so much for joining us today and being our guest. How can people get a hold of you if they want some help with their tax liability?
They can give us a call at 888-GET-MISH or visit our website at getirshelp.com.
All right, thanks again. And Darrin's going to be staying with us for our next episode of podcast, which I want you to check out. Also, if you're in need of bankruptcy financial help and you want some assistance learning what your options are and if bankruptcy is right for you, you can reach us at 214-265-0123 or at allmandlaw.com. Thank you again for joining us for this episode of Credit and Bankruptcy, and have a wonderful day.